Hey YouTube, what's going on? My name is Patrick France, Senior Instructor here at VectorVest, and I'm going to be bringing you guys another video here today talking about one of the hottest stocks, or one of the hottest talked about stocks of 2021 so far. That's right, you've guessed it. If you can't see right above me, we're going to be talking about GameStop today. Now I know there's a lot of videos on it, and so you're not going to want to miss this. We're going to be taking a look at some of the speculation, we're going to be taking a look at some of the technicals, and why some of the big money may be wrong about their call on GameStop. So if you're looking for solid analysis from a name you can trust, make sure to stick around for this video as we get started. So before we get into it, don't forget, hit that like button at the bottom, share this video with all your friends, subscribe to the YouTube page, and let me know if you're holding on to GME right now. Let me see all those diamond hands in the comments here. All right, so with that, let's talk about GameStop. GameStop has been in the headlines non-stop this year. Whether it's that parabolic climb all the way up to a high of just shy of $500 back in January, or it's this new run that we're starting to see potentially developing as of the last couple of days. Either way, GameStop is a really exciting tale about the retail investors versus the hedge funds or the institutional investors out there. Now, the reason why I wanted to do today's video is because not only do I hold GameStop because I like the idea of this trade, I like the stock, I used to go to GameStop when I was a kid, and this is a historical event that I want to be a part of. Now, with that being said, GameStop is one that is pretty much a pure speculative bet. It's not about technicals, it's not about fundamentals. You hear everybody on TV talking about how GameStop has a lot of debt, they're closing stores, it's a rundown company, it's outdated, and they would be right. At this time, yeah, GameStop is more of a rundown company. Especially when the pandemic hit, everybody stopped going out, stopped going to stores, and GameStop, which is mostly a brick and mortar store, probably felt a lot of the effects of that. GameStop has made a lot of changes over the last few months to their management team. And you have to ask yourself, why would somebody take a job like that at GameStop if they weren't willing to take on the big feat in front of them? GameStop is working to try to change their brand from a brick and mortar store to a digital store. And that is the way of the future. We've seen tons of companies over the last few years going that way, and with the pandemic, it's definitely accelerated that. That is one of the reasons why these Wall Street bet guys and other retail investors are so bullish on it and looking at it from a value standpoint. Yes, there is a big mountain to climb to get GameStop to a digital company from where it currently is, but these people are up for the task, and that is their goal. If they didn't think they could accomplish it, they probably wouldn't have taken on the positions there. So from a value standpoint, yes, there's a lot of work they have to do, but they seem to be ready for the job and ready for the task ahead of them. So that makes GameStop, when it was back at $20 or even $40 a share, definitely a reasonable, sound value investment. But then all of a sudden, everybody started talking about a squeeze. Now, if you're not familiar, the short squeeze, what essentially it is there were so many shares that were sold short or bet against that the stock was going to go down, that the retail investor saw this as an opportunity to make a quick buck. Basically, the retailers are buying up shares left and right as much as they possibly can on the hopes that when these short positions start to cover, they have to buy their shares and they won't be able to buy those shares on the market. So therefore, the retailer holds the price and can sell it for essentially whatever they want. Now, everybody thought that the short squeeze and squoze, essentially, back in January, but there is a lot of speculation that there was manipulation in the stock, and that's what drove it down, and these big investors or big institutional short sellers found ways to hide their shorts. Now, I'm gonna let you know before we really start moving forward from here. From this point forward, there's gonna be a lot of speculation. There's going to be a lot of ifs, ands, and possibilities that we're going to be talking about. Unfortunately, there's not the data out there to confirm what exactly is happening and whether or not these retailers are right, or maybe they're just left holding the bag, wishing and hoping for a dream at the end. Either way, it's a very interesting story, especially if you follow it. There's lots of different angles that come into play at this, and we're going to try to cover some of those all right now. But once again, I wanted to let you know this is a lot of speculation coming from this point going forward. All right, so if you're still with me, let's jump into some of the speculation. So, what has been going on that made GameStop all of a sudden start to spike again? Well, there's been a lot of rumor and a lot of evidence, not yet confirmed, but there's been a lot of evidence talking about how the hedge funds and the large institutional short sellers against GME have really been masking their positions by utilizing ETFs. One popular ETF that you're going to hear about a lot is XRT, which is the S&P 500 retail ETF. About 20% of that ETF was made up of GameStop. And there's actually a lot more of these ETFs that people are using apparently as well. So what the whole premise is of that is that these companies are short selling or betting these ETFs are going to go down, but then at the same time as they initiate that short on the ETF, they're going and buying up the individual companies in the basket of that ETF, except for GameStop. Therefore, it's an indirect short against the GameStop stock, but everything else stays float, essentially making it a neutral trade except for GameStop. So this is one of the things that everybody is wondering how long it can go on for, because the way that they're doing this, they're eventually going to have to cover those shorts, and the interest on the short positions can only be paid until the company runs out of money. So that's why we're starting to see another potential pop coming into this stock, as people are speculating and betting that these short positions didn't actually cover their shorts, but instead tried to hide their short positions other ways so that the retailer wouldn't notice. So all of a sudden, within the last 2 weeks or so, you've seen this speculation starting to pop up on all the Reddit forums and other areas out in the market. And that has made the original retailers start to get a little excited about it again. They've already sat from the 480 range all the way down to the lows of 40 again. So at this point, they're saying, why should I sell now? I've already seen it rise, drop. I've already sat through that. I should just still consider holding. Now, as an actual investment strategy, holding and buying is never a sound idea. It can be for certain stocks, but not these types of stocks, and especially not for stocks that have poor fundamentals. So now that we've talked about some of that speculation, let's get into an article that I found on Friday after the market closed, written about GME, talking about a dead cat bounce. So let's go ahead and take a look at that article real quick and see if the major hedge funds or the big institutions that put out this market news are right, or maybe they have the wrong impression of what they're looking at. All right, so here we go. We're on Business Insider, which is a common news website for markets or for stocks in general. And one of the stories that came out Friday after the market closed, we saw a down day right after the big pop it had the day before. And this is the headlines that came through. And it was called Why GameStop Traders Should Be Aware of the Laws of Twos and Threes. Now, I'm not going to get into all the details, but there was one comment specifically that, as a technical trader such as myself, caught my eye, but let's go ahead and take a look at that together. So if I scroll down here, essentially a hedge fund manager from Whitney Tillison. Once again, that's who the retail investors think they're going up against, is these hedge fund managers. And what it's talking about is that it demonstrated a textbook dead cat bounce this week. And if you're not familiar with it, a dead cat bounce is a large short-lived recovery in a stock that has experienced an extreme decline. Unfortunately, dead cat bounces tend to be bull traps for traders, tricking some buyers into prematurely believing the bottom is in. So, two key things we want to take away from this: an extreme decline and a short-lived recovery. One other thing I want to take a look at is if we go into Investopedia and look at dead cat bounce over and over and over again, it talks about, you can see it here in the takeaways, it is difficult to determine whether an upturn in the market is a dead cat bounce or a market reversal, as market bottoms are difficult to predict. So essentially, it's hard to call a dead cat bounce in the middle of a dead cat bounce. So what that hedge fund manager was saying is that GME already had the dead cat bounce and he was done with it. So just to highlight a few key things before we go back into the graph and take a look at it: dead cat bounce, stock has an extreme price decline, and then you get a slight recovery, and then it moves lower to a new low. And two, it's hard to predict until after the dead cat bounce has taken place. So with that, let's go ahead back into the graph real quick. All right, back on GME. So as we've been talking about, an extreme decline. Well, yes, there was an extreme decline here, but that's after an extremely strong rally which pushed that stock higher. So at that point, you're saying, wait a second, where's that decline? If we go back, let's say 3 months, we see bottom left to upper right. That's not a decline in price. That's an actual uptrend with some extreme volatility mixed in between. But then all of a sudden you had the pullback coming here, and notice it found a floor at that 40 level, which is still higher than it was before. So here's where at first, when I read that article, I saw it. I didn't see these last 2 days. I just saw this jump and then this drop. I thought, maybe he's onto something. Maybe that's right. But then as I thought about it all weekend long, I realized more and more that mindset and that statement is not actually correct. Because one, we're at a higher low here in price, so therefore it's not a decline in price. And two, yes, we had a gap up, we had a pullback, but we're still moving higher. If this was a dead cat bounce by this point, we'd be at a new low and you wouldn't be seeing this L over here on the left because VectorVest automatically puts in the lows and highs on whatever graph time frame you're looking at. So this L right here would be over here, but it's not. So what's going on? Well, that's where getting back into the speculation comes into play. If these retail investors are right on their speculation, that tells us these spikes that we're seeing could either be from a few different things. One, it could be from the big short positions trying to close their positions. And because they're so large that when they try to close that short, there's not enough shares available to them. So therefore you're seeing spikes in price. It could also be that other retail investors that were scared originally see this, have done more research into it and feel comfortable with that research and willing to bet their own money for it and hoping not to miss out on another spike like they saw in January. So there's a few different things that could be leading to this. But for now, as we see it, looking at the data, there's no dead cat bounce to be had with GME currently. Because one, we're not in a decline in price. Actually, if we go back even more here with GME, let's go 6 months. GME has been slowly picking up over the last 6 months. That's not a decline in price there. Two, whenever it did rally to the $400, $500 range, it came back down and created a higher floor or a higher level of support at $40 rather than a $20 it started off as. So if it was a stock that was a dead cat bounce, we wouldn't be seeing it creating that low. From someone who's been learning about technical analysis for over 25 years, this does not show a dead cat bounce. That tells me that by reading those kind of articles that the big brokerages put out on stocks, so if you own those stocks, those are the articles it shows you, seems to be almost a fear tactic. Now, as I said at the beginning of this video, I do hold GameStop. I like the idea of this trade. I like the idea of seeing a stock that was almost closed down because so many people were betting against it start to come back to life. I would like to see GME be able to take advantage of these big pops that they've been seeing in their stock price to get their company back on track and make them a headline company once again. But that's a lot of speculation. There's a lot they have to do to be able to do that. So for now, I'm along for the ride. This is not telling you to go buy GME. If you realize I did not mention buying or selling GME as guidance for you, this is just to give you a little insight and an update on what's going on with the GME trade and why this is a lot different than what some of the big headlines are trying to have you believe it is. So if you guys like this stock, if you guys are diamond hands out there, if you guys are holding on, trying to go to Moon, Mars, Pluto, wherever, let me know in the comments below. I'm excited to see that. And until the next one, see you guys later.